Important information and disclosure. TDW Trader Live seminar presentation is for educational purposes only. All trading ideas discussed by the instructor are for demonstration purposes only. Trading involves a substantial risk of loss and is not suitable for every investor. Past performance is not necessarily indicative of future results. Please read more at https://ttwtrader.com/disclaimer. Let's start this day with the part 6 strategies and then the wonderful part of correlations. I would like to mention that what we have learned and discussed about the limit order book and its visualization with bookmap is not the holy grail. It's not the holy grail. It won't work 100%. You should be aware of that. But, and that's what I insist to say every time to everyone who wants to hear it, but it will work far better than any other trading system out there. Any other trading system maybe you know. I claim that it works at least 70% of the time. What I have measured for myself, done my statistics work, and see that it works more than 70% of the time. And in my world and from my understanding of trading, this is a huge number. If you got 7 trades out of 10, 7 win trades out of 10, it's an extremely good result, extremely good. The best of this knowledge is if you find your own way based on this education material and the knowledge, it will give you, or even maybe restore the confidence in yourself. That's extremely important, that you are confident in your trading, that you know what you are doing and then you execute. And I think that's really what matters. It matters to me that I'm a confident and independent trader because I know what is going to happen. And I will come back and stress again the Mr. Kahneman. He said that we have 2 systems, a very intuitive and fast system, and the other one is slow and logical and deliberative system, which takes energy or needs energy to be executed. When you follow these strategies and this knowledge from this week, the weeks after, the next weeks, next month, then you will be full in control of yourself. And this is something that's invaluable. You can't get more than confidence in your trading. We will see that we can explain a lot of things, what we see on the chart. We can explain it, and we can also name the reason or say the reason why is that happening. From my point of view, if you reach this point of understanding, you don't need anything else for trading. Because the principles we went through this week are valid for every traded and liquid instrument worldwide. It's only the view on the instrument which is a little bit different than the view when you will see, for example, a footprint or candle chart or raincoat chart or whatever chart you have. We will start today with part 6 strategies, and we will go through the correlation part. And then daily preparation is extremely important. It seems that it's a lot of information, but at the end you will see that the daily preparation takes you maybe 10 minutes a day to put everything together. It's really not a big deal to go with them. And then I have an executive summary of the strategies we will go again through. We are here in the strategies. We talked about absorption, exhaustion, sweeps, and this is the language, the nouns and the verbs. Now I would like to go through the strategies with you. No bias, be patient, let the market guide you. That's absolutely important. Let the market guide you. Just to repeat it, liquidity absorbs market volume, and where market volume is absorbed, then there's a vacuum or energy is taken out of the market. By that I mean volume is taken out of the market, and when the volume is taken out of the market as well, there won't be any liquidity. Everything around these events is noise. And we should understand that an absorption can take place minutes before the market lifts off or goes down. That is something I think you understand, or you have understood, or you will understand. I have put together some strategy symbols. So for your convenience, I'm putting this on the charts here, just to focus your view on this large volume, liquidity, traded volume, divergences, reversals, pullbacks, correlations, and sweeps. As said yesterday, meaning of dots equal volume. That means we got every day an exaggerated market or exaggerated situations where we have huge sells and huge buys, as we have seen that, or we will see that is in yesterday's replay. And therefore, don't go with a crowd. Don't go with a crowd here. Don't go with a crowd here. Resist. Try to resist. Try to find this fellow here. Let's start strategies part 1, liquidity, sweep, trades, and pullbacks. I would like to apply the strategies based on the studied market mechanism, active and passive indicators. Also understanding strategies and their execution with liquidity, sweep, pullback. Finished auction is wrong here. Let me correct this. Additional analysis methods will follow in the second part. As said, this is the first part we should discuss. Going to the correlations, then preparation, and then we will have some executive trades or executions which are really promising. Liquidity as target, as always, we have discussed it really intense this week, that liquidity acts as a magnet for all markets. Without liquidity, there is no trading. I think this is very, very clear. And if you have question here pertaining liquidity, please let me know. We shouldn't go or we shouldn't proceed if you don't clearly understand the role of liquidity. Liquidity can answer where the possible targets are, but liquidity can't answer to 100% that this liquidity level is going to be a strong level. We need more information to say, okay, this is a firm liquidity and that's not a firm liquidity. We should be very clear about that. We shouldn't fall in the trap that when we see a red area or red line, we have to go long or we have to go short at these levels. We need confirmation, and we should answer, why is this happening then? We must answer, why is this happening? It takes a little bit time. It's slower, as Kahneman said. It takes energy, but it pays off. Liquidity is providing or taking energy. Absorption, book flipping are support and resistance. Order book imbalances we talked about yesterday. Use liquidity as your guidance, orientation throughout the trading day. And the last sentence, it's absolutely important to me. Use liquidity as your guidance, orientation throughout the trading day. We will use liquidity in our prep section, because George had a great idea yesterday. I documented it in the presentation here. Let's say we have 3 priorities of liquidity. Priority 1 is the long-term high liquidity. Priority 2 is the mid-term long high liquidity, and the priority 3 is the short-term high liquidity. That what pushes the prices up or pushes the prices down. Use the liquidity as your guidance, orientation throughout the trading day. So follow liquidity. That's the first rule we should keep in mind. Follow liquidity. And when we are going to to the preparation section, I added a similar page to this presentation. We will see before the market session opens. Then you have liquidity sitting around. You have liquidity sitting on higher prices. You have liquidity sitting on lower prices. You can use this as an orientation. And that's absolutely important. Please keep in mind that this is always a kind of compass. It's a compass for us to understand, liquidity hits here this price level, it retraces back a little bit, and then it seeks a new liquidity here. And then finally it happened with an absorption. Can you answer this question? How do we know that this is the final liquidity level where the volume is absorbed? What else do we need to understand what is really happening here?
And well, there is part, is not volume that is going to tell us the traded volume?
Yes, but yeah, it's the volume, but I would like to point to a certain part of the whole mechanism, of the whole chart. Where do you see what volume is traded there?
Order book.
Yes. Please keep in mind, we will see that a little bit later in yesterday's recordings. We know liquidity is there, and it was absorbed, and then it goes down, but new buyers came in here. They are striving and looking for another liquidity. Then the question is, why does this liquidity, or this level here, not hold, but this one? And the answer is, please have your order book on the right side. Either you are using my suggestions how to set up the book map, or maybe you are working with, for example, Jigsaw. It's nearly the same. It's a little bit awkward to work with both, but I would suggest to have the order book on this side, and you will see that everything is absorbed. The volume is absorbed, absolutely right, but we should know when and why. That's the point. Only deciding based on liquidity level here, it's a little bit, at least for myself, too less. Let's see an example here. You see that it absorbed everything. This is, go back, this is the situation here. They absorbed everything, and you will see, I'm sure when you look at the order book, you will see a high pressure on this side under the offer. But at the end here, at this point, you will see a large number, but nothing follows. No volume here above this area. If you are not sure that this is really the end of the swing, if you are not sure, then wait until they are retracing this area. I'm not sure whether you can get a fill here. Maybe if they are trading a lot, then you can get for sure a fill here. But if you are not sure, then wait until they are retracing this area. Or try to get a fill here, because this takes a few minutes to restore, to retest, and then it goes further down. And then, that's the point. That's our orientation. You have a clear target. This one or this one. Absolutely. And that's, guys, I think that's absolutely amazing to have a tool here, which shows in front the possible targets. I think this was the move here. Yes, it was the same here. Right. This is the pressure up. And by the way, on this chart, you see how a lot of energy is traded here. A lot of volume is traded here. Again, a lot of volume is traded here. And then it snaps back to the lower extreme here. No, it's not the extreme, but to the lower liquidity here at 60 even here. So, and then we have the next target here. By the way, this was really an easy trading day, so we don't have this clarity every day, to be very open. But we got days where it's extremely easy to trade. It's extremely easy to trade. Oh yeah, it's the same. Let me see that. It's the same one. This is a picture book trading here day. You see that? You're here. You have to go long somewhere here, and that's your target. 9 points. Whatever you get here. You got wonderful book flipping here. Wonderful support on the way up, a bit support. And it sits there for 3 hours. This liquidity was there, started at 5 my time to 8 p.m. my time. That means, yes, 3 hours. You have every time you need to decide what to do and where to do, and then you have very clear targets. That's not common in this trading business. That's not common in this trading business. Okay? Question now is, if the price is in the middle of nowhere and we have 2 liquidities below and above, what should we do?
Well, we could do one of 2 things. We could stand aside and wait, or we could zoom in and take a look at what price is doing, how they're pushing price around, and then how long-term liquidity reacts to those large fills.
Yes, I liked your first idea to stay aside. And as well, yeah, you can zoom in and see what is going on here, because we had a sweep here. We had a nice sweep, and then price snaps back. As always, it tries to close the gaps. You can find an own expression for that. Low volume nodes, untraded areas, whatever. But all these untraded areas here should be closed. Normally should be closed if nothing happens. The first idea, I think, is really very, very good until the market signalize you that they want to push the price further down, for example, in this example here, in this case. When you don't have any liquidity above or below, then it's really hard. It's a 50-50 game. You can toss a coin and then decide either to go long or either to go short. In most of cases, the price is going up because this was a sweep or whatever. They were retracing. The reason for this move up was, of course, the sweep. And then if you don't know what to do, first of all, wait. And second, in most cases, I would even like to say in all cases, liquidity comes up, either on this side or on this side. And that signalizes to you, okay, they want the price to go to this further down, to this 38 area. This is the next target possibility. Maybe they can support it at 42, but anyway, we don't know at this moment. But what should we rely on? Where should we lean on in our decision is to wait until we have a decent liquidity, in this case here above or around this 51 area. Then we get a confirmation the price is likely to go further down. So as long as we don't have any confirmation here from the market, my suggestion is wait.
Sorry, Walter. So you just said if you see the liquidity above the price right now, if you would see, this would be your confirmation that higher liquidity, that the price will, the market will actually go down.
Yes. Yes. If I want to trade it, if I want to trade this, if I want to trade this is now a hypothetical discussion here, by the way. If I want to trade this, then what I would like to point you, we have two, yes, we have two extremes, one at 55 and one at 38. Now, if you want to trade this, then I would recommend, because given we don't see this white line here at 52, we don't see anything, everything is blue in this case, then wait, because you don't know whether the price is going further up towards this 55 or it's going down to 38. If you want to trade this, wait until liquidity supports your idea. Either it will come up here or it will come up here. Either way, something will going to happen so that they are repelling this market in one direction or pushing this market in one direction.
Walter, you're saying that you're waiting for support for short-term liquidity, yes?
Yes, absolutely, absolutely. If you don't see anything here, stay out. Sit on your hands, look here. You need always in this market, we need an indication. Therefore, we are looking at the limit order book to get the indication or confirmation for our trading idea in the limit order book right now, without lagging, in real time. Or we are just lazy and don't look at this limit order book, but then please look at what the market is saying to you. Look here, this is a good example here. Look here. This is a short-term high liquidity here, this orange one. They are indicating, not my friend, not with me, go further down, go further down. There are people who are doing this, they know more than we. So that's a reason. This is a reason. We can rely on the numbers. If we have the right data feed, we can rely on the numbers because they are indicating that something is happening here. No other people except us see this one. So they're pressing the price down. Then we have a nice sweep. The sweep is retested. You see that energy is taken out with less energy down. This is a divergence here. Now the price is here. And when it's here, you know, it's a 50-50 chance. You can put your money on in the casino or black or red and then hope that it goes in your favor. But what I wanted to say, wait until something happens here around this level, price level. Wait. Let me see. I think, not quite sure here, but I think this small liquidity here was enough to push the price here down. It's just for the discussion that the price is going further down to this 42, maybe also this 38. And the latest point to go short was here. You see that how impressive they came up here with liquidity and pressed the price here down. So liquidity always acts as a magnet, as an orientation for us to see what the market is doing. It gives a chance which is higher, probability which is higher than 50%. So first of all, liquidity is priority one. We have long-term liquidity and short-term liquidity. Long-term liquidity, we need to find orientation through the day. Short-term liquidity is liquidity which pushes the market up and down, or directs the market, or steer the market in a certain direction. We must pay attention to that. And to get the confirmation, we need the limit order book here. We need the numbers here. We need not the numbers to read every single price level here, but we need the numbers to read the extremes and understand what is happening at these extremes here. Trade into the sweep. We have discussed so much about the sweep, and we are going to discuss further this wonderful opportunity the market gives us every day. It is not easy to trade. It's not guaranteed that you will get every time a fill, that you will get every time the retest you expect. And it needs experience. To be very open, it needs experience. Maybe you should test it either on the paper trade or trade the micros. It's absolutely okay to test your strategy with the micros. Don't trade with E-mini contract. Use the micros. It's a wonderful opportunity to trade and to test, because if you are wrong, you lose a few dollars, and that's okay. That's learning money. That's absolutely okay to adjust your strategy around the sweeps. As discussed, it's always a 90-degree move. It's always extremely fast, maximal. Let me correct this. It depends really on the instrument. You are trading 20 seconds at least, which is very, very short, but very, very rapid, very brutal, as you see. Leaves always a vacuum, as we have discussed. Vacuum must be closed within a short period. Always. There are exceptions, but most of the time the matching algorithm is trying to close and to trade every untraded price level. Is always triggered by algos. Is most of the time the end of a swing. It's a capitulation. Liquidity not existing during this part. On the way up, it's a very you will see it sweeps to a liquidity level where absorption happens. Volume at the beginning of a sweep is not existent. So when the sweep starts, you will see that there's no significant volume. At the top or bottom, there is big volume cluster. There is a big volume cluster, as you see every time. Always followed by a massive reaction to the big volume cluster in the dome. Limit order book shows no volume because of the speed of the move, and chart range volume profile shows no volume either. So if you have the normal volume profile, if you're following the normal volume profile, you won't see significant volume on that levels too. Maybe 1, 2, 3, or very, very low volume, which is maybe traded. It means this queue is not depleted. This queue remains in the book. So what I have done is just an visualization. Yes, this is, I'm calling that the sweep buster. Yes, they start with a low volume, they leave a vacuum on the way up, and they end in big volume. Like here, that one, this one, and so on. So we will see that's where we want to trade. That's the classical. That's the classical one. Sweep happens. Sweep happens here. Then it retraces with lower volume. You see that? And that's a wonderful short area. That's what I'm calling really reliable trades. These are the, how to say, normal trading days or normal times where this sweep happens, someone is flushing, the toilet bowl is empty, it needs to be refilled, then it goes back and hopefully retests this area. We have also liquidity here and we have liquidity here, over there. That's the classical move. One of the moves you will see very, very often or during the last days is that the sweep happens and immediately you'll see that this liquidity was taken, absorption was taken here. It comes to an upswing a little bit higher than this absorption, and then immediate it snaps back here. This is not tradable. I would not say that this is tradable in any way. If you want to trade this one, then wait again until a retest happens. By the way, we will talk about the CVD, and the CVD is indicating a sweep by a 90-degree move here. You see that in the CVD? We will talk about sharp delta, and we are working, or I'm working on a sweep indicator 2 to indicate this one, but it's just only a signal. It's a signal that a sweep happened. It doesn't answer or give you the signal to trade a sweep. It's really, by the way, extremely hard to trade this one. Resist, don't do anything. Wait until you got this retest here into this area or wherever it happens. Same here. And here we can see wonderful the cooperation between sweep, absorption and exhaustion. You see high volume here, high volume here, and as always we have a divergence. We have exhausted area here. You see that? There's one, that one, that one, this one, this one, this one, this one, this one. If you compare the dots, these dots to this one, to this big one here, you see it visually very clearly what is happening here. This happens now and then, and we have to be aware that sweep happens to the first liquidity area, and then it seeks the next liquidity area. Please remember that liquidity acts as a magnet. So if this happens, you don't have any significant significant retest here. You can't do anything here. So according my rule, you can't trade this because there is no retest whatsoever. There's no retest whatsoever. Hence, you can't trade this. But when you hammer it into your brain that liquidity is there, is a fuel, is a magnet, or is a line of attraction, doesn't matter how you express that or how you see that, but then it's very obvious that they are seeking this liquidity here at this point. This next one. As said, I can't give you 100% rules where you start tomorrow or next week. Okay, Walter said this is one, I have to take it, and then it works 100%. I hope you understand that. There are some variations, but I bet there are not more than 5 or 6 variations, even less than 5 or 6 variations, how they behave every day, every day in and day out. You can do your own examination based on this knowledge now. This is the theory. Let's talk about the execution. Sweep trading requires experience. Sweep indicates a pause in trading, a reversal, stop runs. We talked about that. The execution is wait for the largest volume or large volume cluster in the sweeps. A fill of the tops is most cases unlikely. Slippage, if you look at the CL. Wait for a retest with lower volume. Consider this entry as the place and place your stops above the liquidity level. If there's one, it takes some time to lift off or to drop. A sweeps indicates further to clear your position, to tighten your stops, on the end of the price movement. The disadvantage of a sweep, as I see that, maybe you have your own opinion about that, is that it can happen 1, 2, 3 times in a row. It's dependent on the instrument. I saw that in oil. I think this can happen so that you don't know where to enter. So if you don't know where to enter, then anyway, stay out. Trade into the sweep, execution 1. Sweep, immediate rejection. From my point of view, really hard to find a fill here. But given that you want to trade this, then you have the short area here in this area, this part of the area, but the stop must be above the liquidity. If you have a firm liquidity here, and you see that on the offer, maybe 1,000, 1,500, when we are talking about ES, then you have to put your stop area above the liquidity. Not somewhere here below, but above the liquidity. So if you are entering somewhere here, then your stop should be maybe 2 points to maximum 3 points. Okay, you see also this is the CVD, the normal CVD. You see the sweep. This is the 90 degree, and don't argue about if the sweep is a 90 degree or it is 85 degree or 82 degree. It doesn't matter. Something between 80 and 90 degree is a sweep. And then you see a nice divergence here. That is the depiction of what I have showed before. Is the short area somewhere here, and the stop area must be above. This is CL here, must be above this liquidity level here. I found, I think, 4 variations for the sweep. What happens? It was the execution 1. It hits directly the liquidity. Most of the time, they are getting cold feet, I hope it's the right expression also in the US to get cold feet. They mean they eliminated, they're selling everything what they have. What they are selling, the inventories here long before the liquidity. What happens? They are book flipping and trying to push some buyers up into this liquidity area. So these are poor souls who are trapped here because they are thinking, oh wow, we have a volume spike and I have to jump on the volume spike because this is a very strong move up. Maybe you know your own arguments, maybe you have been in this situation. So they think, okay, baby, come on, there's a lot of people who are buying after me. I'm secure when I enter this move. They are even supporting this area by a book flip. Then the move goes against this liquidity area and it stops rapidly because there are no enough buyer to lift this offer or to hit this offer, whatever it is on the offer. More than 1,000, 1,500 contracts. This is the divergence we are talking about in the CVD. This is the sweep. From my point of view, that's the most secure because this move takes time. It's highly probably that you get a fill here somewhere and the stop must be above.
Walter, when you look at the CVD for a sweep, say for instance on the ES, are you looking for a certain positive or negative? Like, are you looking for 500 contracts, 1,000 contracts? Is there a rule of thumb, or do you just look at the 90 degree, the CVD?
Yes, I'm looking at both. You can use the normal CVD. First, I'm looking for this 90 degrees here up, and then secondly, I look for the volume on the volume or in the limit order book. It's extremely important to understand what's going on here. I need a rationale, and my rationale, my personal rationale is, if something happens here, I would like to see what is going on here, what is happening here. How does the CVD behave here?
So you're not necessarily looking at the delta change in the CVD. For instance, let's say the move up, on that last example is, say, roughly 2,000 contracts. You're looking at what comes out or what the energy absorbed at that level really is.
Yes.
Okay.
Yeah. Try to keep it as simple as possible, because what I'm looking at is not only the CVD. Anyway, if you don't want to look at it, then I think volume is absolutely sufficient to see what's going on, what is happening here. If you look simply at this chart, then you see the 90-degree move here. You see the high volume here. You see the liquidity here. You see the liquidity there. And you also have the chance to read the numbers. This is 1, 2, 3, 4 different information you got for this move here. And I think this should be enough to understand what is happening, try to execute, or to make your execution then. To understand, okay, the market is coming to an end here. And when we are here, we don't exactly know where the end is. But we have liquidity as one information, and the second one is also liquidity there. It's really hard at the moment when that happens to decide. The first intention is to go long here. It works for a few ticks. And the last one, if you are not happy with this one, if this doesn't work, maybe you are so fast that you get break even, or you are out with break even, or even small loss. But then take your time. You see liquidity is coming up. You don't need to go long here, but maybe you can mark this area with a rectangle and then find your entry somewhere here. And also, if you want, you can use the CVD as a divergence, positive divergence in this case, indicator to signalize, okay, market is going up. Is that what I'm talking about, what I talked about? So high volume, information 1, information 2, information 3, and maybe you can also have a look here at the order book to see really what is happening here, how much was traded here. Is there enough power to lift the offer at this point? Or did they hit the bids immediately after this was absorbed? You will get a right feeling about that. I'm sure you will get a right feeling about that when you're looking at it, because, to be very open, we are not used to take these techniques for our trading. I suppose that. I'm not sure, but normally where we are trading this kind of charts here. Let me add another one. So this is the common looking of a chart of few colleagues who are trading the Ichimoku, for example, Ichimoku, Kinko, Io, and you see they get the signals here for a long position and don't see anything what is happening on that way. So you have the VWAP, which is an absolutely important part, and then you have your own indicators, whatever you want to have, whatever you want to put on the chart. Doesn't matter. You have overwhelming numbers of information on your chart, so that it's really, really hard for us humans to decide based on that. But the reason for all those indicators, it doesn't matter what indicators that are or these are. The reason for that is simply because we have not been taught about the market mechanics and how the market acts and about the limit order book. We need security. Every one of us needs security, and that means if we are putting more and more and more indicators on the chart, that means a kind of security for us, for our trading, for our money, to protect our account, to protect our money against losses. And the more information you put on the chart, the more difficult it is to understand and to see what's going on here and what is happening, how to act. That's the dilemma most of us traders are. This is this example. We have 90 degree, we have the sweep, and it retests then the next. You see here book flipping. It retests the next area, and that's really a wonderful secure trade. It's a secure trade because all the speed is out of the trade, and that's important. All the speed is out of the trade. I mean, everything can happen. Normally, in normal times, when we see the absorption at these levels, then look here, it takes enough time. It's the speed of this move is out. As again, maybe it's a little bit boring for you, but when we say that's a very hard speed, there's a 90 degree move, then this is a very slow speed up. You can draw a triangle and usually see it's up there, and then it goes slow. It goes a little bit faster than normal, but it goes slower down than a 90 degree move here. So it takes time. The speed is out of the market. You have enough time to react on your position here and to manage your position. Same here, short area, stop area. But that simply, look here, divergences. You understand, I'm sure you understand what I'm talking about, what I mean. That's the principle of the execution too. From my point, the most secure point, I like it because everything is out and it takes time here. Okay. Execution 3, that's at the bottom. That's the bottom case. What we see here, it's not quite the same, but it is very, very similar. A sweep happens. A sweep happens here. As always, energy. So absorb this guys, these persons, these institutions are out of the market, and now the market is left to the to the retail traders. Let me say that this way, to the retail traders. And it goes down, it goes up, it goes down, it goes up, it goes down. It's a nice accumulation area. It's a nice accumulation area here. This takes time, maybe 30 minutes. 20, 25, 30 minutes. Hard to say, depends on what instrument you are trading. And that gives us enough time to digest all this information here. All this information. First of all, a huge volume cluster, and it gives us time to reconsider our position, to find our stop area. Maybe a book flip is coming in. And then you have a nice entry, a really riskless nice entry with an absolute great MAE to consider to go long. That's my favorite too, because it takes time. So I have enough time to understand, to see what is developing here, and then taking the trade long. That was CL. It's always the same. When a normal sweep is always described as a 90 degree plus vacuum, and in normal cases, it stops it happens with absorption, and then it flips back or down, depends on. But anyway, it goes down and it takes time to lift off. You see that here, the divergence.
Walter, I wanted to ask you at this point here, is there any correlation between how much does it take to accumulate the volumes at certain levels and how far later the price is going to go?
No, the first answer is no. There is no correlation, or there is no rule of thumb to say it takes for oil, for example, 10 minutes and for gas 30 minutes. No, it's not. My experience shows that you can't say I'm trading CL, this happens, and then I have to wait 10 minutes. The accumulation happens here, and then it lifts off. It can happen in 5 minutes. It can happen immediately after they're retesting this area, this level again, and then lifts off immediately. No, there is no correlation. I can't say that. My experience in ES is that ES takes around 15 to 30 minutes for accumulation if this happens. But I wouldn't bet on that. So you have just to watch it and to understand what is happening in these areas. Once you understand, it doesn't matter, because you have to take your position here. You'd have to place your stops there, and then hopefully you are right and the price is going up towards this liquidity area here. This is the big one. No, it's not. And the second question was... Excuse me, I forgot your second question.
Sorry, yeah, so what I meant is, how is the proportion? So, for example, if the accumulation is going to take, let's say, 5 minutes,
yeah,
the move later after the accumulation is going to be quite short. But if the accumulation was taking like half an hour, maybe 1 hour, the move might be like huge.
No, yeah. Yeah, the answer here is very clear. Look for liquidity. There's no correlation between the length of the accumulation and the length of the move up. The answer to the second question, from my point of view and from my experience, is if this happens, you are buying and then look for the next possible liquidity here. It might be 72 here, because it seems so. Let me see next. Yes, that was the area here. And I can't say whether they are hitting this one or whatever, but the next liquidity level is important to look at, and then trail your stop, manage your position. Maybe you are trading 1 or 2 or 3 lots, whatever. Then take profits. Let one runner in the market, and then you are safe. For example, that's one of the best strategies you can have when it can goes even towards this 80 or 88 area here. So the first question, it's hard to say how long it takes. The second question is very clear. In our case now, we would look for the next liquidity levels. If we get a support here, for example, it supports our idea that the market is going further up. If we have a nice liquidity at 80, then assume that the market is going to hit this 80 level. Exception is always on the way up. Anything can happen. So they are flipping the book and bringing the price down against this 20 area. In oil, very, very common. You have also here divergences when you look at that. This is, yes, the same one. Long before this happens, this area here, against this liquidity level here, the business was done here. Not here. Here. And that's absolutely important to keep in mind. Business is done here. Excuse me, here. Not here. This is just a gift to us to understand what is this, because it relates This position relates to this one. Excuse me, so one. Come on. This position is the reason for that for this event here. This is only a gift for us traders who understand what to trade, that this is a sell area. I did a decision table here. Basic decision table for conservative entries. Do we have a sweep? Yes. Retest? No. Wait. Retest? Yes. Entry on low volume. Entry okay? Yes. Runner. So you can do your own. You can do your own decision table. That's only a suggestion how to categorize these sweeps, because we don't have many variations, maybe 4 or 5. And then let's use these variations of the sweep and find that one which really works for you. So this is, what was this? This is in gold. Oh yeah, gold. Totally forgot to talk about gold. You see, it works the same way every time. We hit this first level, this long one didn't work here. We had the second, they cancelled. After they hit this level, they cancelled before, and we have 4 liquidity levels below. Then you have to wait. If you lost, if you did a trade here, wait maybe until they hit the last liquidity level here. If this is the last one, given this is the last one, they jumped up extremely fast. So when we want to trade this area, we are not trading here. We are not trading here. Then, is it a sweep? Yes. Is it a retest? Here, let's say this is the retest here. Yes. Entry on low volume? Yes. We have lower volume here. If it's okay, then manage your entry here. But I suppose this was a sweep 2 here. Anyway, it was. It is a good example how to trade extremes. This is really extreme trading. Execution 4. What happens is sweeps in a row. You will see most of the time that there's a sweep 1, sweep 2, and then they are hitting the liquidity area. As again, we are selling this one, and we are placing our stops above the liquidity. So 1, 2, 3, and they are hitting this liquidity level here. Let me say this is the 4th variation I find on my excursion on this quest in my trading. Let me talk about that one. The first one. You see what happens? This is our entry, and it works for 2 points, roughly 2 points here. Then you have to keep in mind that you have all on the way down red dots. If you have only red dots or green dots, please be very cautious. In a healthy market, you will see red and green, red and green, red and green, a mixture of red and green here. But if you have only red dots on the way up, or green dots on the way down, on the green dots on the way up, then be very, very, very cautious. This is a kind of exhaustion. Then the second one, given that we don't know that and we are trading our normal, the second one retraces a little bit. So you are maybe short at 35 even, and it goes to 34 even. So you are still in profit. It's maybe 1 tick, though, but anyway, 1, 2, 3, 4 ticks, you are still in profit. And then we get the third one, which is the classical. It goes down, and you are still in profit here with 1 point, let's say 1.5 points here. and goes further down, retraces, and then comes down. So it's not scary to trade them, but when you see, and it will be a feeling, you will see that, you will feel that when you are wrong here with this move, it goes a little bit in your favor here, maybe 1, 2, 3, 4 ticks maximum. But if it doesn't develop further, fast, in a good time, then stay out or close your trade and wait for the next one. And at the end of the day, every tick counts, guys. Every tick. We have the same here. We have the sweep here. We have the sweep here. We have the sweep here. And we have the sweep here. Exhaustion on this level. Retest. So be aware that several sweeps can happen on the way up or down, and that they are seeking liquidity. They are seeking liquidity, guys. Liquidity is the mother of all trading. We need to understand that. We have liquidity here and here. If this happens, you don't get an entry, or you got an entry, but it's only good for 1, 2, 3 ticks, then stay away and look for liquidity. What is really happening on the chart? This is the most difficult sweep to trade, from my point of view. You see that? You have sweeps up there, you have there, small ones. This is oil, by the way. Funny stuff here. But that's the area of interest. That's the area of interest. So what we must keep in mind, first of all, look of area of interest. Where are they? What are they? Where are they? And then try to understand what the market is doing. Most of the time, especially in oil, for example, or as in every other instrument, they are looking for this area here. It's like a magnet for them. It gives them, they need fuel, and then they are looking to touch this area somehow. Advanced trades, I think this is the fourth or fifth variation, is the sweep correction. I would like to put it here on the chart because it's absolutely important, because it happens really all the time. It happens really all the time. And when you see that, please be aware that this move is likely to go further up or further down. This is really advanced scalping techniques. This is for experienced trader, but you will spot it. You will see that. You remember we have 3 important indicators. That's time, volume, and price. Time, volume, and price. And time is the most underestimated indicator in the trading arena. That's simply because, again, I stress it, because we are concentrating, what is this guy, what is this indicator here doing? What is he doing? He is rising, it's green, so I have to go green. No one pays attention to the time factor here on the chart. They are really rare. This thinking is really not developed in the trading arena. Time is extremely important. Let's see some examples. Oh yeah, here, that one here, you have the sweep. They retraced 50% of the sweep. Let's say 50%, it's roughly. That's not scientific number or whatever. Please don't take it as such. It is simply an estimation that the market is retracing here, and even you see that we can play both sides now. Given this is a sweep and I have shown you and hammered into your head, you have to go against the sweep. You have to go against the sweep. Even if you manage that here, you are good for 1, 2, 3 ticks. So far, this is the good message. The second good message is, even if you are following the second variation, you are trading the retest. You are good for 1 or 2 ticks or break even. But most of the time, please keep in mind that if this happened, if it doesn't drop enough and close all the gaps below here, then it is valid to assume that the price is going further up to these levels here. There is probably liquidity over there. Like here, see that? Let me show you. I think it was like this one here. Like this one. 5 minutes. So they went up, and let's say this is 30, 40, 50%, doesn't matter. And then goes further down. Yes, please.
Walter, when you look at these Fibonacci levels, or take a look at them, and let's say you're looking at obviously the 38.2 or the 50 or the 61.8, is it possible to draw a fib on a move or on a sweep, and then based on where that liquidity is, obviously you're always looking at the long-term liquidity for the magnet, but when you see a short-term liquidity come in, say at the 50% level, does that increase the chances of that trade at those fib levels? When the liquidity comes in at those points?
Yeah, I know what you mean. I worked intensively and extensively with the Fibonacci's and with harmonic patterns for years, and today I'm absolutely sure that it worked 20, 30 years ago, absolutely, because the markets and the economy was in a stable uptrend, and everyone was looking Fibonacci's and so on. But in today's market, I highly doubt that this is going to work. So I have never examined or tested to place Fibonacci here, for example, where the move begins. These are 100%, and let's say these are 38%, 40% here. I have never done this work, so I can't say that really whether it works with 30, 40, 50 or 60%. The best estimation you will have, and the most reliable information you will get when this happens, the move goes down, it takes few minutes. It takes few minutes to develop, and then you see suddenly, or not suddenly, liquidity coming up here. Then you are absolutely, you can be absolutely sure that this is really an area where something interesting is going to happen. So if we draw, I think it's not possible here. No, it's not possible. If we put Fibonacci levels on this one, given this is the start of the sweep and this is the end, this is 100% and 50. Well, let me calculate it. 11, 95, 96, 5 points, 2.5 points, 98. 96. What do we have? Oh, excuse me, 96. This is 10. Then 15 points. So this is a move of 15 points here, roughly 15 points, 7.5 points. That means 4.5, around 31 or 4 here. These are look here. These are really 50% here. If you take this one 11, even minus 96, these are 15 points. The half of 15 points is 7.5. Add 96. 96 plus 7.5 are 350. Yeah, look here. This liquidity comes up with a 50% retracement or correction. These are around 50% here. So I would rely on these indications because they are absolutely reliable. They are drawn, they are plotted in time, they are plotted based on the data that are coming in from the order book, from the exchange directly. They are translated and transformed and plotted here onto this chart. This is more reliable than maybe Fibonacci's. To be open, I have never examined that or did tests with Fibonacci's and retracements here. I can't say that. Pullback strategy, the prereqs are trending environment. We have pullbacks always in trading environment. Pullbacks or reversals are always in a trend, always in a trend, always in a trend. Pullback or reversal, name it how you want. Conditions, move ends in a volume flurry or large volume cluster. Absorption of volume happens, covering or profit taking starts. Then volume pullback ends in depleted volume, exhaustion, divergence in chart accumulated volume profile, CVD, and in the volume profile. And liquidity, good short-term high liquidity above, below the volume cluster. Pullbacks are extreme secure trades, guys. We talked about that yesterday. You remember we have a small covering, short pullback. This is the best one I would like to have. You can play and breakout here, but the best one is to wait until we have short-term high liquidity over there and short covering starts here. And then it goes against this level. And that's a good short area, again, a re-short area if you're not in. Pullbacks can be treated differently. It's always a good sign. If you don't see liquidity here, it's always a good sign to see liquidity around the pullback. It's always a good sign. So how to trade given the price is coming down? Most of energy is absorbed here. We see also divergences in the CVD. And then we see short-term high liquidity here coming up in the book. And then it's not 100% precise, 100% precise. It's around here. This is the sell area. And I'm sure in this scenario here, you will find the next liquidity level below here somewhere. Pullbacks happens always in trending moves. Look for short-term liquidity above the last large volume cluster. Let the market trade towards the short-term liquidity. Remember, price seeks liquidity always. Place your trade below or at the short-term liquidity. Stops must be above the short-term liquidity. And the volume at those levels or below the last large volume cluster. And let the market trade towards the short-term liquidity. Remember, price seeks liquidity always. Place your trade below or at the around the short-term liquidity. Stop must be above the short-term liquidity. Volume, low volume, close to short-term liquidity. We have divergences. Exhaustion is indicated and also divergences. You see that? Yesterday we had the situation, but it doesn't work 100%. You remember when the price came down and the liquidity above formed? The price went up, but the market was so weak that they even had no interest to trade. So the pressure to the downside was great, was immense. So there was no short covering. That means if they don't touch the liquidity above, that means there's big pressure for a further move. A lot of traders who are recognizing that leave their position as they are. Okay? They leave their position as they are. They don't cover. That was similar to yesterday. It's not yesterday's move. It was similar to yesterday because we had this strong liquidity here, sitting here, and then this pullback area or this liquidity came up. Market went against it, but didn't even touch this area. And then you see a wonderful target. So when they are not covering enough, that means that's nothing else but the traders who are into this trade know or hopes that the price is going further down. They are keeping their positions into the market. They are keeping their positions into the market. They don't want to cover here. And this is the next level. This is a classic situation. Comes down. You see how they are put the lid on the pot here, touching this one, going up, touching again, retracing here against this pullback area, and then looking for the next liquidity level. Impressive. It's simply impressive. Everyone who is following this seminar and this kind of view on the market will be impressed how the market is really telling us every day what he intends to do. The only point or only task we have to do is to wait patiently until we understand what the market is going to do. And that's, at least for I'm talking about myself, so at least it's very hard for myself sometimes to sit around and to watch paint drying and to understand what the market is doing. But most of the time I'm happy to know what is happening, because this saves me so much money, and I'm really in profit nearly every day when this happens. Okay, what is this? Similar, it's forming here and then it's going down, similar like that. You see that? Pull back at its best. You can't get a better entry than here. Your risk is 72 to 73. Maybe your risk is 1 point here. 1.5 points. And when we are talking about, let me show you that. Improve MAE and MFE, maximal adverse excursion and maximum favorable excursion. When we are talking about that, we are talking now about the optimum entry and the optimal exit. The optimal entry and the optimal exit. So if you are going to measure and you make statistics about your trades, MAE and MFE is an extremely important measurement part of trading. So consider that. But with this technique, you don't need to have a 5-point or 10-point stop. You know exactly what is happening. You know exactly what is happening. I would like to go to the replay of yesterday's ES. Are you ready to start? This is before the opening. This was the market yesterday. This is before the opening. Let's go a little bit further. I would like to to start. And in this case, I'm anticipating a little bit what we are going to talk about in the preparation section or preparation topic. This is when is this? This is 22. That means 9:22 Eastern Time. And this is the picture we have. Let's freeze the picture here and want to switch this off here. So this is the picture we have. We are a few minutes before the open, and I would like to ask you, what do we see here? What is our orientation?
Yes, initially that 15 and 17 quarter could probably be pretty close to being the same.
Yes.
However, do you find that a level like 17 quarter, where you have higher liquidity at two levels, is stronger than, say, 15 or stronger than 19?
It's hard to say. It's hard to say because it's pre-open. But what I wanted to point at is that before the open, few minutes, we'll talk about that preparation section. But it's absolutely very important to know where the liquidity is sitting. We have, as you said, 17 a quarter, 15 even, and 19 even. There's certain good liquidity before the open. This can change, but remember what we said about liquidity?
Well, liquidity attracts the market.
Yes. Yes. And liquidity is the attractor. So that means before the open, we have the first impression is we have a good attraction here, and we have a good attraction here below, 3105, and then let's see what happens in few minutes. Making fast forward to see what is really happening here. But this is what I want to point at is look at the liquidity. We have a nice band here at 19. We have upcoming liquidity at 17 and then 15. And below we have...
What's interesting there, Walter, is that 15 is long-term high liquidity. So is 19. But technically that 17 quarter is not long-term liquidity based on the open.
Yes, absolutely. The reason is that maybe the traders come in the US at that time, and they are planning their day. More than often, you will see that liquidity is coming exactly is loading up exactly at the open. It's quite important whether this is short or long-term liquidity. We only say it's liquidity there, and it can happen because it happened at 3 p.m. Let's say 3 p.m. my time. That means 9 a.m. Eastern time. That means these players, these players, the market players and market participants are signaling at this moment what they want to do. So it's impressive to see this is let's say this is a long-term liquidity, as you said. Then this is a very in relation to this one, a short-term liquidity. That's a high-term liquidity here at 15,400. We have 417. Let me say exactly 470 here. 15. We have 17,465 and 318. So we have strong liquidity there, and we have 400 below at 0.5 even here. So that's the first impression we have of our market. Then let's start. Let's see what's happening. And as said, price is seeking liquidity. That means we should expect that the price is going towards these levels here. Let me reset the columns. You see also the book is quite good. I think that means we have more on the ask side than on the on the bid side. Now players are coming in now. You see that? Players are coming in. Huge volume unloaded first, and then this was absorbed. The point what I want to say is when we are going back here a little bit, we have to find the trend, and we will see in the correlation section how the correlations with the market help us to understand the trend of the day, or maybe the possible trend of the day. It's absolutely paramount to know that this is an edge of your trading, or this is going to be an edge of your trade. This is the advantage you will have, because there are not so much people who understand how to use this correlation with your markets. Anyway, I'm talking a little bit later about when we go to the strategy executions. You can also rebid or rejoin. You can simply join a move. When you know this move is going to go against 15, against 17, then it's absolutely thinkable, it's absolutely imaginable that you simply join the move when it goes against. It depends on your trading style. It's your personal decision, it's your personal trading style if you rejoin. Rejoin or join the move when you know the facts. Okay, we have a move up, we have liquidity there, and here. Why not take a few points out of this market? Absolutely legal. There's nothing illegal. This is absolutely imaginable to trade this market that way. By the way, a lot of traders are doing that. Okay, that's the point. And then let's see the open.
Yes, by 526.
This is the first reaction on the absorption. You remember whenever this large volume was absorbed, it takes time to find new buyers. It's always the same game. Hitting the liquidity, being absorbed. It comes to a retrace, and then the next liquidity is waiting. But we are now concentrating on what? What would we expect here? What is the next move?
I see more liquidity at the top rather than the bottom.
Yes. So
I would expect that this market would move up.
Yes. Absolutely valid explanation here. Yeah. And that is one of the many proofs that liquidity is important. We should have more information about the liquidity, whether it is firm or not, but we have proof this week that liquidity acts like an attractor, or is an attractor, acts like a magnet. So if the price is here and nothing special happens, they are seeking this level here. We can't say whether they're going through that at the moment, but they are seeking this level. And when you think about that a little bit closer, or when you have time to think about that, that implies that you can't, that you can place your trade or simply join the move, because you know they have, no, they have not, but they are going to hit this one, they are probably going to hit this one. So why not take 2 or 3 points out of this market, let's say as a bait.
Walter, look at the volume at the bottom, the divergence of, interesting that those 3 different waves.
Yes, but please consider following. At the open and at the end of the session. At the open and at the end of the session, we have huge volume. Don't lean on this volume at the beginning and especially at the end of the session. So a lot of positions must be cleared here around. So therefore, even you can say for you, the first 10 minutes of the session open, it's not my time to trade, because a lot of positions must be cleared, and new positions has to be taken, and so on. So the first, I don't know, what's the open interest time for ES? I think the open interest is 30 minutes for. If you are looking at the volume profile, then I think that you have an open interest time of 30 minutes for ES. 15 or 30 minutes. That means during this 15 or 30 minutes, I'm not sure what's valid, means there's a huge interest to find the way for the ES. That means a lot of people are clearing their positions, taking new positions. So sometimes it's absolutely not visible or not understandable what is going on at the moment. Therefore, you have a high volume here, a lower volume here, and lower volume here. If you want to trade this, the point was, look at the liquidity. So we have to look now at this area here. Our first idea was right. Market is going up and touched this 15 area and then touched this 16 area, 16, 17 area. Precise, it touched the 16 and a quarter area. Now look here, they are pressing up. Point of control is at 1550, 15 and a half. This is an area where it's really hard to trade. Either you join the move, get a little bit out of this of this move here. As said, sometimes you need a few points on your side as a bait. I would like, it comes from fishing. So if you have a bait to fish bigger to catch bigger fish, maybe it's good for that. But it's your decision. The principle is very clear. We define and we see where the liquidity is, and then either we wait or we are so brave to take some points out, or we sit in front and try to understand what is happening. You see that? Green is larger than red. Green is larger than red. So if we got a chance to trade, which level would we consider to be a good entry for a trade? If we're preparing ourselves for trading, which levels would be interesting to trade?
15, 16 for a short for me. Possibly 13 for a long.
Why 13 for a long?
Because of the move down. I mean, there's really no volume there, but it looks like there's probably some type of a sweep that came down.
Mm-hmm. Yes, it is. It is kind of a sweep, a weak sweep, but anyway, a sweep. You see a lot
But
of.
that would be my second choice. I would be leery of that simply because of the liquidity down at 10.
Yes, but okay, you are looking for longs here. So
Actually, I would be looking for a short.
okay,
At 16, 15 area.
why not 17?
Because they're coming down to me. It looks like they keep coming in just above these 16 quarters, and it looks like there was a little bit of a flurry there at 16 quarter and a little bit less volume this last time we went up to 16.
Mm-hmm.
Maybe a little exhaustion there.
Mm-hmm. Okay, good. Then let's see what is going to happen, or what is happening, or yeah, what develops here. Let's do it a little bit slower here. That was too fast. They try to flip this move again up. So you are right, George. I'm coming back. Let me see what is happening here. I don't have it in mind, but this was a lot. The point.
That would have got me really nervous.
But you know what I'm pointing at is always the same behavior, because we had large volume here. Let's go back and study this again. 51. 50. Let's reset. Just, yeah, we have to study that to understand what is happening here. Let's do it a little bit slower. So this is what we saw on the chart. It was a small and tiny sweep here, and as always a sweep must be corrected. You see that? It's really hard to say to trade, to be very open. I would like to wait until the 17 area, but let's see how this works out. You see that? Trading here above. They are hitting 560 traded at 16. Now they flip the book and they are advertising at 17. So let's see what's going on here, what happened here. I really don't know.
Probably have my stop just above that 15 quarter.
Yeah,
area.
that's absolutely okay. Yeah. Now they are flipping again and trying to press the price down. And coming back again, absorbing this level. The next one is 1550. Feeding the buyers. Hitting and hitting, yeah. You see that? The green bars, just a moment. The green bars are leading. So therefore, I repeat myself, and maybe it's boring for you. I suggest to put this on your chart because you have more information than without it. So you see what happened here. 1,100 traded at 16. And that would be, at least for myself, I'm looking for numbers higher than 500, so higher than 1,000, to see what is really happening here. This means huge absorption. So we didn't see whether, because it was too fast, whether they are stacking now on the offer side. It was too fast a little bit. The question here is, guys, colleagues, where should we enter? Where should we enter and when? We should enter when we see a really big volume hitting either the ask side or the bid side. And by high volume I mean, but when I'm talking about ES, I mean 1,000, 1,500 and so on. So this is a large number for myself. And that could be a good sign to think about, to find a position to sell. Let's see whether to given I'm short 16 even, or maybe something like that here.
Walter, so you're looking for that size of contracts traded on the ask or a bid prior to high liquidity?
Yes, that's it, because what I said before, I need a reason to trade. A reason for myself to trade is liquidity. A reason for myself is to see stacking on the offer, high volume, hitting the offer without lifting the offer here. These are market given arguments for me to understand what the market is doing here.
So would your preference be to see the absorption on the offer side and then 1,000 to 1,500 hitting the bids after that?
Yes, absolutely. What I want to say is that you should have a look. You should understand the limit order book, the dome here. I think you do so. You understand the differences between the ask and the bid. You understand what the aggressors are, the market orders here are, the aggressors. You understand the pulling and the stacking now. The volume profile is obvious. Quote center, you can have it on your chart. There's no need to have it on your chart. If you want, you can decide on yourself. But when it comes to trading, when it comes to put your money in the market, you should be better than your opponent. You should have more and better information than your opponent. You are trading against, let me see, another guy who doesn't see what is happening here. And therefore, it's okay to have a CVD, for example, here. It's absolutely good to have a CVD and to see whether there are divergences, whether we have volume divergences. But when it comes to trading, you should have more firm and reliable information in front of you to decide, should I put my money on or not? And that's the point that we have to keep in mind all the days, all this week and the weeks ahead, to understand that we need reliable information, we need reliable data. So let's see whether this works out for myself or not. I will do it a little bit faster. What gives me the hope is that they are flipping the book here. See that? So my stop must be above this liquidity here. But anyway, if I got a 16 even, my stop is 17 and a half. This is the retest. Guys, this is the retest like in our, like discussed. I don't know whether I can I, let me show, can I draw here? Yeah, I can draw. So we had 1000 here. And we had, I think, 800 here. This is the liquidity area we have looking at all the time. From the beginning. With our knowledge, we know this was a high traded area here. And now let's see how this, what happened here. So I'm absolutely comfortable because I would like to to close one or two contracts, or one on contract being with having two runners. Managing my stop so that I'm not hit by a sweep or whatever in the market. In this situation, what is the next possible target?
Well, the high volume area, which is the red line, and this looks to me like this is almost like a vacuum there, because there's in between.
Yes, what do you think this one here?
Yes, sir.
This is 3110. We have 600 contracts. Yes. So given I'm short because of I have good volume, was absorbed.
Exactly where.
Yes, and we good liquidity. So there are 2 or 3 arguments which are in my favor, and additionally I have seen this in the order book. Given I'm short, it works. This could be our next target. Remember, please, it doesn't make sense to zoom in now, because then the whole picture blurred a little bit. So we are talking not about 10, but about 14 and maybe 12 or whatever. That means the presentation is relative to the volume. Therefore, when you are trading, then you can have a zoom in, for example, here, and a detailed look on what is happening here. But when you are trading, you should be concentrating on next targets. This should be the mid target 10, based on this one, and then Hopefully this will work out. Maybe they are coming back here testing against the VWAP. I think the VWAP is not in the right position because this is a replay, so it started at 9 or 10 o'clock my time. Anyway, ignore the VWAP here. So the position is clear, the market proves us right, and then the next target should be the 10 target here. Let's go a little bit faster. We have a lot to do today. Now we got support on the offer. You see that? This was a sweep, a small one. A nice one. Tighten the stops. This is the next to trailing stop at 14. Oh yeah, come on. And what I said is exit your position when you see this, that the sweep is coming up. So this 5 points should be good for a nice result because everything was fine. They didn't hit the 10, and I'm out of the position. The entry here was excellent. You have had a reason what happened. You saw the reason. You understand what is going on with this liquidity here, and you got a nice move down. So what I missed here is this was a sweep, and you have to try to find an exit here, either market or whatever. You see, it's going against you. It's testing, and that's the nasty part of this market. They know that something is brewing, and they are fooling everyone here. When you do this several times, best possible confidence in yourself that you understand what the market is doing. You can't do it better. And it was a sweep again here, I think so. No, we go against the sweep. Look here. What is this?
There's no volume.
Yes. Black space. No volume, nothing.
Walter, when I was reviewing this, I thought it was interesting. If you look at your time, right where your cursor is, if you go to the left until you get to, I'm sorry, the other way. Let's see, 1630 would be 930. So 937 or 1637 your time. Look at what happens to the liquidity there on the bids. Yeah, you can zoom out even more. And then what was interesting is at 1037, the liquidity really drops out of the book again.
Yeah. Here and here.
Yeah.
Yeah.
And it really, to me, was a foreshadowing that there's probably no support and we're going to go south the rest of the
Yes, absolutely, absolutely. I'm just curious. Let me go back to the 35. And let's reset this column here, and then going a little bit slower into this area. there's not so much volume here hitting this level here. We are talking about 200. Now it comes up. Look here, look here. Look, you see this 900 here? When you are trading with ES, I can't speak for CL. I think in CL this number 900 is should be 150, 200. It's not so big, but when you are talking about ES, then everything what is around 1000 and higher is a considerable number to be watched, because something happens then here at that level. You see, no one wanted to trade the 75 area here. The liquidity vanished or was cancelled. Although you see how they are pressing up. You see how they are stacking on the bid. Here, stacking on the bid. You see that? But this is fake. Maybe they are going to hit this again. 18. 400. 500. 500. Again. 800. It was a little bit too fast. But we had, you see, the energy was absorbed here. That's always the same game, guys. That's always the same game. The energy was absorbed here by 1,000, I think roughly 1,950. And then there is no more energy to lift the offer, to eat anything on the way up. There's no energy. So liquidity and absorption takes energy out of the market. And when we want to know how much, and we are talking about ES, then please have a look at the order book, at the limit order book, and see whether we have 1,000 and more. It helps you it helps you in any way to understand what is here, what is developing. We have no liquidity here. Or can we say no liquidity? Yes, there's nothing significant which can excite us. So we had based on our knowledge 2 entries here. First of all was this 16 area, which was good for theoretically 5 points. That was, as Tom mentioned, it was our target, but you know, we can't expect every day that the target is going to be hit. Anyway, we have to manage the move. We saw this sweep here, and as I said, if you see a sweep down, you can hope that it's going further down, or you should be prepared to exit your position. It's really depends on what on the experience. We had this move with lower volume here, a little bit more lower volume, and we had the same behavior here. We had the same behavior here. So let's see what happened. I think this was the start for the down move, wasn't it?
No, there was one more punch up, Walter.
Okay. Anyway, it doesn't matter. We have to go be short here. Because at that moment we don't know what is going to happen, whether this move is good for 10 points, 20 points, or 2 points. We don't know. Now, in hindsight, we can explain everything. That's not the big deal. But we had 2 positions. The first was 16, the second was 17. And it yielded in 5, 6, 7 points. And again, it went against us. Yes, we have 800 traded here, 800. And when you see these numbers traded, and it doesn't have the power to lift the offer, be cautious. Look here. This is a sign of weakness or a sign that someone knows more than we. Book
There was
flipping.
1,206 absorbed up there.
Yes. Sorry? Again?
There was 1,206
Okay.
that were absorbed.
The point is, as again, it's valid to say, first of all, it's our duty to go short here. It's our duty to go short here. And when we see that, it's our duty to go out here. So on the way, on this trading here, from session start, we had two trades or three trades. Let's assume we have theoretically 3 trades. The 16 was a good trade, and the 71 was a good trade, and this 18 was a good trade. So we should close the trade at 14 here in this area. That means roughly we would have 7, 8, 9 points in our account. That's extremely good, because we don't know. It's easy now to discuss what is coming, but we don't know what is coming, what the future is bringing, what they are doing here. If the China news comes up or not, it's really not predictable. Simply as that.
Look at the liquidity come out of the book again at 10:01.
Yeah.
Or 17:01 your time.
By the time you will get a feeling for your market, whatever you are trading, so you will feel and see that the market is highly nervous. See that? The market is highly nervous. It makes you nervous too when you are trading that, because we are expected here to hit the 10 level, and by the way, they canceled that before the announcement. That's also language where the market is saying, hey, stop here. I'm not willing to trade this one here. This is a clear sign. This is a clear indicator. And you will see that the market is extremely nervous. The nervousness is shown in this zigzag behavior. You see that? It is simply a matter of time. When you are trading your market with this method, you will understand that the market is extremely nervous. And when the market is nervous, maybe they are expecting something. And so the people who are trading, nobody knows at the moment what is going to happen. Some one of the traders has more information, so they are expecting something about China. The other don't even know that there will be some news about China, and that's what you see here. This zigzag, this depicts the nervousness of the market. You will learn that when you stick with your chart, when you have every day the same chart, you will understand that something is happening, because this is not so obvious, this is not normal. It's nervous. So the guys are selling, and then maybe they get a little bit hope to buy, and then get sell again, a little bit hope to buy, until the real news the real news came out. Oh, come on. You see here again, not sure what we do, what we expect, what we should expect. This is completely nervous market here. This is the heartbeat of the market here. Really, you will see that and you will experience that when you're having every time the same, trading every time, every day the same instrument. When you have every time and every day the same setup, you will feel the heartbeat of the market here. It's really impressive. Now, I think this was the news. And what I would like to point before we stop here is, there's the situation. We are lucky because we are short, hopefully. What should we do here? We discussed it. Our first anchor is 93.75, okay? Our assumption should be what we have learned. We are in down move, so the move is touching this 93 area, and then we are going, it's hopefully snapping back here, and then we are long here. What happened now? What happened here?
At this level got absorbed. Yes, there is.
No, this one here.
Oh. This just disappeared?
Yes. This one. Huh? Okay, anyway, can't use the spotlight. This one here. Just disappeared. So they put on liquidity there, and our idea, Tom, or your idea was, okay, I have learned the sweep, and when it retests this area, then I have to go long. That's what I have learned. Walter told me this is a sweep, a 90 degree, and then goes 50% up and then comes down, and this is the area to buy. So I should go long here around 94.
Well, except the volume is no longer there.
Yes, of course, it's no longer there. That's one point. But we need lower volume here. To be very clear, we need lower volume here. We need divergences. We need high volume here and low volume here to go long, because the market is exhausted here, or is trying to, yes, it's exhausted here. But the point is, what I would like to say is, the initial idea was, okay, this is a sweep, a huge sweep. We have a correction of the sweep. And my idea is to take a long position here, because it retests with a high probability this area, and then it goes back. At that moment, this is our first idea to trade this one. Yes, I think big players are pulling away liquidity to make a wait for further move down. Absolutely, yes. So we have to overthrow our first idea and to wait what is going to happen. Now they are coming back with this liquidity, and now second or third liquidity forms below here. And we know liquidity is always an attractor. So because the first idea didn't work, they canceled that. Be very cautious with that. And second liquidity came up 4 minutes later. Second liquidity came up 9 minutes later. Then, because the rule is still valid, it doesn't matter whether we apply the rule here or here, but the rule is still valid. We had a huge sweep down, a huge sell-off. The market must retrace and try to close this vacuum. The question is now where. And the first idea was we are going to take this area for a long, and because it was cancelled in front of our eyes, we have to cancel our idea and to wait for the next opportunity we have or we get. Now we have here the next opportunity. That means our idea is we have to look for this move, so we have to find, when we are brave and experienced enough, we have to find entries here. You see how they are stacking on the bits. This is a very, very good floor here below. Okay. Correlations are the most underestimated and even not discussed tools in this trading business. So this is our plan. We are now behind the strategies and correlations. We will coming back to the daily preparations. We will come back to the executions again of strategies. But correlations are absolutely important. Correlations gives an additional level of confidence in trading. Utilize this additional information in your daily trading decisions. You have to. I don't like the word must and have to, but in this case, I would like to emphasize that this is a must. This is a must. That's not optional. That's a must. Let me show you what I mean. Correlations. Many markets have close interdependencies. Correlations help to see and recognize the direction of a market. Correlation is a statistical measurement that determines how assets move in relation to each other. Although correlations exist, they must be always viewed in the economical context. So everything fits together. We are not isolated. The yes is not the only one instrument in the market. The CL is not the only one instrument in the market. The treasuries are not the only instruments in the market. The yes depends on the share market, for example. So if we want to have an advantage in our trading and know at the beginning of the market where the market is selling to, or whether the market is weak, and although it is seen as weak, it goes up. Something must be wrong. Something must be wrong. So again, many markets have close interdependencies. Correlations help to see and recognize the direction of market. That's what I want to show you. All correlations must be always viewed in the economical context. Let's assume we as a team are trading the S&P 500. That means we are trading the E-mini, ES-E-mini, as shown here in our example here. We are concentrated on this chart. We understand the moves, the sweeps, the liquidity, the absorption, exhaustion, and so on. And we are working out several strategies or few strategies which are working for ourselves. And now we are extending our knowledge to this extent that we accept, or we have to accept, and we know that S&P 500, for example, is not a stand-alone instrument which acts on his own. It is not. It depends on the Nasdaq 100. It depends on the S&P 500. It depends on Dow Jones. It depends, the S&P depends on the volatility index. It depends on the SPY, the ETF fund. And also, believe it or not, it depends on the dollar-yen relation. Look here, we have in Nasdaq 100 the Microsoft, Apple, Amazon, Google, Facebook and Intel, also Alphabet. All those companies makes 45% of the Nasdaq 100. Their weight is 45% of the Nasdaq 100. We can't ignore that. Also, when we use the same or take the same companies, Microsoft, Apple, Amazon, Google, Facebook and Intel, they have a weight of 3.8% of the whole S&P 500 index. The same for the Dow Jones. They are making nearly one third of the whole Dow Jones weight. One third of the capitalization is in Microsoft, Apple, Amazon, Google, Facebook and Intel. When these huge companies are raising or are being bought, then you can see the impact on the S&P 500 directly. And then additionally, we have other influencers on the S&P 500 which we can use. For example, there are several more, for example, but I'm pointing at the volatility index and the SPY, the largest ETF fund, directly related to S&P 500. We will see that in yen. It's a hedge fund instrument which is highly used the last weeks and months. Please keep in mind that nothing works on his own here. S&P as well as other indices are not isolated. And why shouldn't we use this information about Nasdaq, S&P, Dow Jones, the volatility, the ETF and the dollar yen to our advantage? We should do that because it gives us clues every single day what the market is going, in this case the S&P market is going likely to do every single day. Look here, only one correlation between ES, Microsoft and Apple. You can see it literally. So we have the same market behavior in Microsoft here, in Apple here, like we discussed this week. So nothing changed in terms of our mechanics, market mechanics, in terms of our terminology. Nothing changed. It doesn't matter whether you trade shares, Microsoft, Apple or whatever, or you trade futures, or you trade Forex at the CME. Nothing changed. Everything, the knowledge remains the same. The instrument is, of course, a little bit different. The knowledge about the market behavior, market mechanics remains the same. You see that very, very clearly, ES, Microsoft and Apple. If you only watch this one, you can get a clue what the market is doing. We have absorption here. At the same time, we have extreme good liquidity at Apple. At the same time, we had an extreme good liquidity at Microsoft and also traded high volume here, high volume here, high volume here. Now put several charts together. This is the ES, Microsoft, Amazon, NQ and Apple, and this is the volatility index, the SPY, and the yen. I think this is the yen here. Now we are in the position to trade. We are trading ES. We are weighing liquidity and the volume here. And on the right side, we have Microsoft, Microsoft, Apple, and Nasdaq, and the YM. Or in this case, it's Amazon. On the left screen, we have volatility index and the SPY, and we have also the yen-dollar relation. What is happening here is we have had a strong buy in Microsoft. Microsoft shares has been bought like crazy here, as well as Amazon, as well as Apple, as well as Amazon. And of course, because they are going up, Nasdaq is also rising in the same speed, with the same speed. On the other side, the volatility index is a counterpart. So if the volatility is coming down, so the fear is disappearing out of the market. And the SPY, you can see the SPY as the same like here as the ES, ETF. Then we are in an absolute strong and firm position to buy the ES. In this case, it even doesn't matter where we find an entry, because if this is rallying, if this is raising up, and so on, the fear is decreasing, SPY is up, also the yen-dollar is decreasing. We have to buy it. We have to buy ES. We don't need to think about liquidity. We don't think about volume and so on. All the fine stuff. This is a whole picture how the market behaves. It helps us to define the direction of our traded market. If we are not in a trade here, then we have to use this liquidity here, this bid support, to go long. We can only go long. We can't go short, because nothing is going short here. Nothing is going short. Nothing is going short. You will see also days where everything is going short, then you have only to sell these instruments. You have to sell the instruments. You will see days where Apple is up and Microsoft is down. Nasdaq is going sideways. This is also one-to-one transferable to the ES. The correlation of markets is extremely helpful. That gives you the advantage, a huge advantage, to see more than other traders who are concentrated on such rubbish here. They are concentrated to go long or to buy something because this Ichimoku is green here. They are concentrated to go short. I don't know why. I don't trade this, because got the signals here. Too late. The move started here, not here. And then you are looking at your indicators. You are staring at your indicators. You are concentrated on them. You have 1, 2, 3, 4, 5, 6 indicators or more on your chart, and then you're looking, when do I get a crossover of this one? When do I touch the MACD, or the Bollinger Bands, and so on and so on and so on. You're concentrating on that, and you don't see what is going on here. It costs you nothing to see on one view what is happening in the markets. Just look right and left on your screens, and you will immediately know. In a blink, you will know what is going to happen or what is happening. And then it's really hard to decide to short this one, because if this is rallying, then you can't short this. You have to look for entries here at the liquidity level, and then let the market take you with the market here. With it. Let the market decide where to go. It's extremely easy. It doesn't cost really much. It's only the data feed. But when you have it on your hand, when you see that, then you immediately know what to do. You have days where it's extremely easy, like this one, and you have the sideways days where it's really hard to say and what the markets are doing, and you have days when they are going in the opposite direction. It's also easy to say, I can't only sell, I can't only say, I can't go against this market. And that's an absolutely necessary knowledge, because you know where the market is, the overall market is going to. Once you understand that, then you can say, okay, if I got liquidity level there, the market is up, I have to find my entry somewhere here or here below. Or you can simply rejoin here, join the market, because you see that sometimes they are so fast, so wild to buy this market. You see that. Join it simply here. Jump on the train and ride the move. Just a few words to SPY versus ES. The SPY of S&P 500 Trust is an exchange-traded fund which trades on the NYSE Arca under the symbol SPY. SPDR is an acronym for the Standard & Poor's Depository Receipts, the former name of the ETF. It is designed to track the S&P 500 stock market index. This fund is the largest ETF in the world. It is designed to track the S&P 500 stock market index. So going back, this is the SPDR, the ETF fund. It is designed to trade the stock market of S&P 500. And therefore there's a one-to-one relationship between SPDR, the SPY, and the ES. We have the same on the NASDAQ side. We have the QQQ. The PowerShares QQQ, previously known as the QQQQ, is a widely held and traded exchange-traded fund that tracks the NASDAQ 100 index. So this is the opposite of the SPY. The NASDAQ 100 index is composed of 100 of the largest international and domestic companies, excluding financial companies that are listed on the NASDAQ stock exchange based on market capitalization. Therefore, QQQ is heavily weighted toward large cap technology companies and is often viewed as a snapshot of how the technology sector is trading. So if you are trading in Q, you must have a look at that QQQ. And as well as the YM too. So the correlations of the volatility index. The volatility index is an index created by the CBOE, which shows the market's expectation of 30-day volatility. It is constructed using the implied volatilities on S&P 500 index options. This volatility is meant to be forward-looking, is calculated from both calls and puts, and is a widely used measure of market risk. The VIX is often referred to as the investor's fear gauge. Volatility and the index move up when stock prices are falling and investors are fearful. The index volatility and fear decline when stock prices are rising. Going back here. But the fear is declining here. And when the fear is declining, that means actually for the market that the market is going up. And one of the maybe even to you unknown correlations or correlation pairs or instruments is the US and yen. Let me show you that very shortly, very briefly. This is the US. This is the yen. This is gold. And these are the treasuries. This is a 30-year bond here. You see, maybe it's the first time you see that, but I will only briefly mention it. You see that the the ES is raising a little bit here, and yen is sliding down or coming down, also gold and as well the treasuries here. By that, we can roughly say that this market, the ES, is in an uptrend. It's an uptrend. Suddenly something happened today in the market, and in the same moment when it happened in the market, yen is rising, gold is rising a little bit, not now, and the treasuries are up. We can feel the mood of the market by only watching those three correlations to the ES if you are trading ES, or those three markets. This is euro, but it doesn't count, it just for my information here. In the preparation section, we are going through this one to understand what could be the move, or what is the mood of the market. And when you see that in a long term, so we don't need it at 5 minutes, we only need to see the fever curve of the markets. Then you see it's going down, down, and as soon as it starts raising here, ES is dropping. We should expect a weak ES in this case. But we are going to this a little bit more in detail a little bit later. Please keep in mind that US yen is important for the ES. Why? Because investors shift their capital in case of uncertainty from stock markets, indices in forex markets. Again, investors shift their capital in case of uncertainty from stock markets, indices in forex markets. Yen is seen as the negative indicator of the S&P 500. Again, yen is seen as the negative indicator of the S&P 500. There is a tight correlation between US and yen and S&P 500. Yen is in difficult times the flight to quality. S&P 500 and yen have normally an inverted ratio to each other. This can change. It's not written in stone, you know. It's not written in stone that this works every year. There has been years like 16 where it didn't work. At times of high correlation, yen is used to hedge against the S&P 500. Rule of thumb, if yen soars, indices will drop, and if yen plummets, indices are rising. So if we use this rule of thumb, what we see today is yen is dropping and ES is rising. As soon as something happens here, it's really extremely fast, then yen is rising and ES is dropping. So you see that on this picture in your documentation. Yen is down, ES is up. It's quite a common. So when we see that for a few days, when we see the curve of yen and then ES, then we can say that this is going to be a positive day for the ES, especially when they are dropping so fast. We have to look for buys here. This is the 6J and this is the ES. You see how they are reacted. It's nearly at the same time. They sold into the liquidity. The liquidity takes everything out of the market. It was a huge absorption in the yen, US dollar. This is the 6J future. At the same time, I'm sorry, I have 18 p.m. That means 6 p.m. my time. Doesn't matter. That's noon time in New York. EST. You see the same behavior here. dropped into liquidity, touched the liquidity at whatever, 26.14 here, and dropped down. You can't ignore such information because first of all, the 6G is available to all of you. There's no excuse. As long as you have CME data, 6G is available for all of you. Also the NQ and YM, what you don't have maybe is Apple and Microsoft and Amazon and so on. Maybe also not the volatility index and the SPY, but this can be solved. That's not a big deal to solve this. So this information is already there. You should, and we must connect this knowledge together to get a complete and holistic picture about that what we are doing on the exchange and what we are trading. This is the relation between the yen, the volatility index, and the ES. Bookmap comes with a correlation tracker, so you could easily have those correlations on the chart. I would not recommend to do so because of performance issues. You can use the correlation tracker, but be aware the more you put on your chart, the worse becomes the performance of Bookmap. The best way is, in my opinion, to have several charts open. You see immediately what is happening. Look here, this was a sweep. You remember what sweeps are? A correction. Now let's come to the treasuries. Also, the treasuries has an extremely important impact on the S&P. The 30-year bond, CB 10-year T-note and the yen and 5-year T-note correlate strongly. If you want to trade treasuries, then it is highly recommended to have the 30, the 10, 5-year, maybe also the 2-year bond and notes open to see the correlation. They are strongly correlates. Sometimes you have the advantage that the 10 years a little bit ahead, and if the 10 years ahead, then be sure that 30 years also following. Stock and bond markets correlates contrary. When bond market soars, the stocks are likely to fall, and vice versa. Investors tend to shift their capital. Investors are hedging the S&P 500 market against the bonds and vice versa. So that adds the picture. If you're trading S&P 500, then it's absolutely necessary to see what the bond market is doing. So you don't need it to have it on on the Bookmap chart, but you have, I'm sure, either Ninja Trader or maybe you have Thinkorswim or Sierra Chart. I don't know what you have, but it doesn't matter what charting system or platform you have. It is important to put this information on your desktop or on your chart. For example, you have the ES, then you have the ZB, ZF, ZN, and then it gives you a nice picture what is really happening. Look here, the treasuries are rising all the way up, and the ES goes the contrary way or goes the opposite way. And also when you are looking at, when you are trading treasuries, then you have to look at the ZB, ZN, ZF, for example, because they are related to each other one-to-one. There's no chance to look only at ZB and don't look at the other pairs, or not pairs, but the 10 and 5-year and 2-year. Treasuries. Okay, trading preparation. What I'm doing is to have a macro view, and a micro view. I'm trying to get historical data. I'm using cloud notes for my information only, and I'm using custom nodes for ad hoc entries. It might sound a little bit odd, or it might sound a little bit cumbersome, you know, how to say it. But once you are accustomed to that, when you do that every day, it takes you, I guarantee you, colleagues, I guarantee you, it takes you not more than 10 minutes. What I'm doing, I'm using the, let me show you that. Let me remove this disturbing one here. I'm using this chart simply to get the yesterday's high, yesterday's low. I'm using to have the yesterday's close as a gap and the regular open here. I'm also watching the VWAP, yesterday VWAP, and maybe 2-day and 3-day VWAP only, just for my information. That's all, nothing more. And I'm putting all this information in the cloud nodes. Pre-high, pre-low. You can find your own. That's what I'm doing. You might find and doing your own levels here. This is the symbol, this is the DX feed, this is the rhythmic feed, and this is the micro ES here. So I'm putting all those levels once I have it. Transfer these numbers here into my cloud nodes, and then I'm connecting this cloud node column here. And pasting the link. I'm pasting this link. I'm pasting this link. What you get from Google Notes here. It's the easiest way, by the way. You can do it also with OneDrive. You can also do it with OneDrive, but it's a little bit, yes, it's a little bit odd to adjust it or to put it on, because OneNote is not giving you this this link here. It's really easy to copy this link, and this link is pasted in the cloud notes download URL, and that's it. Automatically I'm feeding all my charts. You can also do it for InQ, you can do it for ZB, for whatever you are trading. CL, of course, gold. And so I have information, rough information, mostly about the high and low and the open and the close. So I'm not looking for gaps. It's highly interesting on some days. And also you can put your own information. Come on, where is it? Yeah. You can put your own information then on your chart as you like it and want it and so on. I'm doing that because I'm in my preparation, I'm also watching for extreme levels, supports and resistances, which are quite reliable, and then putting this markers here on the cloud nodes. Okay? It takes you really not more than 10 minutes a day. So that was my preparation. I stepped aside from that because I'm using this cloud nodes. Please go into the documentation, and it's really obvious. It's not difficult to get it into your bookmap chart. You can also do it this way. What I have learned is following. Let me show you something maybe you don't know or you are not aware, but let me show you something what it's really helpful, or what might be helpful. It's not applicable now to this one because this is the recordings. But given, let's assume this is a chart with I have a history data of 7 days, so I'm receiving the data of the last 7 days. So I have a good overview over the history of this instrument ES. You can subscribe to up to 5 days, I think, in Bookmap. So it's really highly recommendable to receive history data. But anyway, look here. Let me show you the following. You can. There's a button here, configurable visible components. Configurable visible components over there here. You can switch everything off your chart. Everything. Let's given that this is the POC. So now your chart is completely empty. There's nothing on your chart. Use this function configure visible components. Then add only candlesticks to your charts. That's it. And now, given that we have 4 or 5 days of history data, then you can as well compress or zoom in into the chart, and then you can start to draw horizontal lines based on the swings which happened. And then when you are finished, because sometimes algos are trading between the swing highs and swing lows and swing highs, swing highs and swing lows. Simply keep it on your chart. It doesn't cost you anything. Everything is there. It makes only an effort for maybe 1 minute to put everything on chart. Then switch everything off. Again, add heat map, best bid ask, last price, I don't need an ask price, VWAP, volume bars and volume dots, and you are back. And this horizontal lines remains in the chart for this day. So you see sometimes extremely well that maybe that was a high of yesterday's high, or whatever it was. It doesn't matter now. Just wanted to show you how you can add lines very accurately at on your chart. So that's what I wanted to show you with this documentation here. It's obvious what is happening here, yeah, isn't it? If you want to do this way, that's a suggestion from my side. Look at it, test it, work with it, and if you have another style, use it. Everything what brings you in profit, it's okay. It's great. Let's talk about the trend definition. And that's what we do in the live education room. And I would like to urge you really to motivate you. Do it as very same or similar way. Trend definition. What I'm using is the current market data to prognosticate the daily trend. Correlations are highly reliable indications. Look for 1 day and 2, 3, 4 days back. What is or what was the trend? Mark previous daily data in your chart, high, low, gap, open. Mark important liquidity levels, long-term high liquidity, in your chart. Use additional technical indicators like McClellan or similar if you need to. Use a decision table. Always be aware that current analysis can be affected by daily events. We are not sure at any moment in the market. When we got a tweet today, it changes dramatically. While the Obama was the president of US, it wasn't so. We had a relaxed time trading. We had sweeps, but not so much like today. And we live in really turbulent times. So please keep in mind that every preparation can be overthrown in a blink. Always be aware that current analysis can be affected by daily events. So this is my trend definition table or decision table for my trading. You can do it your own way. So this is an example from S&P 500 Future and the ES Mini. What I'm looking, let me show you that here. I'm looking at the ES, at the yen. You can put it on your chart as I have. At the yen as a hedge instrument. So if the yen is down, most likely we will have, let me compress that, I can't that. If the yen goes down here, ES is likely to go up. Then I'm looking at gold. Gold is an confidence, it's a confidence index, about the confidence. Is there confidence in the government? Is there not confidence in the government? Is there confidence in the market? Is there no confidence in the market? Gold is a good measurement for the overall confidence in the markets, in the governments even. So if we have unrest, for example, then you will see how gold is rising because it's a hedge against all those uncertainties. It goes also hand in hand and most of the time with the yen. Look back 2-3 days. Then look here, you can make such a chart, ES, YM, NQ and the treasuries. And you have a good overview what is really happening. If we are trending down in the treasuries, we will have likely uprising market or yes, in the rising market here. ES, YM, NQ, NZB, NZN, NZF are down. It's everything you need. So you have a good overview about the market. What we saw, and that's remarkable, colleagues, that's absolutely remarkable. Look here, treasuries are up since what is this, 11th, 14th of November, treasuries are steadily going up and up and up, and as well as the NQ and the YM and the ES. And I bet, and you will bet, that when this happens, something is amiss, something is weird, something is wrong. We don't know when it will falling, when it will fall down and coming back and going in sync again. But when this happens, be alerted, something is brewing, something is wrong here. Then the shares, Apple, Microsoft, Amazon, Google, you should have it on your chart. If you want to have the technical indicators, maybe you are watching at them, what I find interesting, so you can see is there's a McLaren Financial Publications. You can have this chart in front of you. This is measured on the daily base. You see also nice, this is a heat indicator. I have had some seminars with Steve Hammer. He is using a system like it's like McLaren. He is using his own system, but it measures the breadth of the market, of the Dow Jones here, of the NYSE. You can use such information to understand, look, the market is going up, but the McLaren is going down. If you want that, use every information you need. For the shares, you can use the financialvisualization.com. Technical and daily liquidity model, I will come in a second, and news. So when you are trading, and when you are in our room here, then use the data flash. Data flash is the fastest. The economy data provider. it also provides headlines. So they are announced, you can put your speaker on, and you will get this information on your speaker. You will be alerted 1 minute before the announcement and 10 seconds before the announcement. It's really useful. It's really, really useful. Or otherwise, you can use what I'm using is financial visualization, just for information, and what I'm using is also financial juice. You can use this one and get really, really good messages real in time. Because news can skew the trend, okay? All this information are in your documentation so that you can decide and find your way. That's all, trend definition. So then you know at the beginning of the trading session roughly what is really going on in the markets, and you can adjust your thinking very fast during the trading day when you see, for example, Apple and Microsoft is up or Apple and Microsoft is strong down. Then expect that the yes will follow. And sometimes you will amazed that Apple and Microsoft, for example, are being sold 10 minutes before the year starts to decline. You have enough information, enough time to get to make your mind up and to see what is really going on in the market. So preparation, what we discussed that, watch for liquidity as a first estimate. You know what I'm talking about. So we have priority 1 liquidity, we have priority 2 liquidity, and if you want, we have maybe also priority 3 liquidity, which is short term high liquidity. I would like to say for the daily preparation, just look at the chart. Here we have priority 1 liquidity over there, we have priority 2 liquidity down there, and we have priority 3 liquidity here. And now you have a complete overview of the market, of the pre-market, what is going to happen. And the only point is we have to adjust. We have to adjust ourselves during the trading day, because everything we did here can be overthrown in a second when anything happens. But most of the time you will get a good overview over the market, and it will gives you more than often the security that the market is trending either up or down or is going sideways. So this is the trend definition. ES, yen, gold, what I showed, the bonds, and shares was shares with the treasuries. All those informations are available for you on your desk. There's no need for anything else or to buy any additional data feeds. The exception comes with shares and volatility index and the SPY.
Walter, I've got a question on your pre-market analysis. When you're looking at, say, the liquidity areas of the previous session, and or doing, if you will, a bird's eye view of the where the liquidity levels are before the market starts, and then zooming in, kind of like I'm trying to think of, kind of like looking at in comparison, and I know Bookmap doesn't do it on time, but like for instance, comparing a 1 week, 1 day, 1 hour, 5 minute, when you zoom in and out of Bookmap looking at liquidity levels, do you do that, or could you comment on that anymore?
No, I don't do that, because this could be misleading. What I want to see is the first one, you have to have at least 5 or 7 days of historical data to do so. So I have it. That's not the question. But the question is what is
So
what
when
is
you're looking at, say, the current screenshot that you have up here, and it's roughly 30 points wide. Is that normal? Is that what you're looking at, or does it depend on the price action? I mean, how do you when you're looking at the liquidity levels, are you only looking at the nearest long-term liquidity levels, or do you look at something that might be 20 or 30 points away?
I'm just to answer. I would like to only have a look at a priority one liquidity. That means I would have to look at this one, and maybe we see some days a very strong liquidity over there at 25 or whatever level here. Very, very dark red liquidity here, and maybe also on the bottom side here. I'm just to say that I'm noticing that. I'm placing a marker here on the cloud nodes with an alert. I'm noticing that. But the point is, when it comes to trading, it's good to know what can happen at this level 25 or even of 95 level here if there's a strong liquidity. I would put a marker on, and then I would like to forget this liquidity. I don't look at this priority 3 liquidity or smaller liquidity, just to have a clue, where big players are putting their liquidity or the money on, and to understand what the market is doing. That's all. I'm not looking at 5 days back. I have to look a little bit later when we finish here. Does it make sense to look back 5 days? I don't believe that, because what we want to do is we want to trade this day, and we want to get 10 points out of the market, then close the PC or the laptop or whatever you have, and then enjoy your life. That's at least my goal. That's at least my goal. So to answer your question, I only look for the for the high liquidity, long-term liquidity. It might be 26, it might be 18, it might be 100 or 95 here. And then I place the marker on them, and then I'm trying to forget them. When it comes, given the situation now, I'm short here, and we have this big, huge liquidity like in our example. Then, of course, I'm reminded that when I got a fill here, I'm so in stress, and I try to understand where the next targets are, or where the next target is. And then this comes again in play. It makes my life a little bit easier, because I have marked this level, and I see this level as a possible target. But I don't want, I myself don't want to interpret too much into those levels. They can disappear in a blink, as we know. This one, and as well as this one, as well as this one here. Everything can change extremely fast. And even, look here, and even this preparation, even the prep work, we see that yen is declining, gold is declining, and the treasuries are declining. That means the market is going up. Yes, it was true, the market went up. But then suddenly something happened, and they switched their view too in a second. So coming back to your question, George, I'm only looking for the priority one liquidity. I put the marker on those levels, and then I'm concentrating on the micro view, or on the bird's eye view, on the 5, 10, 30 minutes per chart, like here, to see what is really going on. I would like to have an entry, the best possible entry at a best possible high point. High point or swing high in this case. That's all. I wouldn't like to recommend to over-evaluate the market. Where is it? Can't find it for it. I wouldn't recommend to over-evaluate everything. You can sit there for 1 hour and analyze every single price level and every single market. My experience is that I would like to know the extremes, the swing highs, the swing lows, where is liquidity sitting for a long time, and in this case we have been right. So maybe you are a trader, or I am a trader, who jumps simply on the board, on the train here, and let the price going towards this 15 level, and then I'm cashing in 3-4 points, whatever. It depends really on. But I'm looking just for the high liquidity, and then I'm putting the markers on. Thank you for following up to here. This is the end of day 4 of our live seminar. We will continue with the next day, and we will start with strategies, pattern, execution, summary. Thank you for watching and listening. See you in the next topic.